You buy the place thinking the mortgage is the main boss. Principal, interest, taxes, insurance. Painful, yes, but at least understandable. Then the HOA email lands with the subject line, "Nobody respects until it reaches their own inbox. Updated monthly assessment." Now the house does not just cost what the lender said it costs. It costs what the neighborhood board says it costs too. The first instinct is to shrink the number in your head. It is just the HOA. It is not the mortgage. It is not life-changing. Then you stack it onto everything else already hanging on the property, and the math starts looking hostile. Monthly dues, maybe a special assessment, maybe a fine, maybe a reserve increase because the board finally admitted the building has expensive bones. Suddenly, the fee you use to file under annoying starts acting like a second mortgage with more attitude. That is the shock. You do not just own the unit. You subscribe to the rules, the upkeep, the politics, and the bill. The part that makes it worse is how calm the notice sounds. No panic, no apology. Just polite language about community maintenance, insurance, reserves, shared amenities, or capital improvements. The sentence structure is always civilized. The effect on your budget is not. You read words like adjustment, assessment, operating costs, and reserve contribution, while your brain translates them into one sentence. This place is more expensive than it was yesterday. And because the fee does not feel as sacred as the mortgage, people mentally underestimate it until it starts eating the categories that made life tolerable. Eating out goes first, then the savings rebuild, then the random flexibility that makes adulthood feel less like a hallway. That is when the HOA stops feeling like background maintenance and starts feeling like a governing body with direct access to your monthly cash flow. At closing, the HOA fee is usually presented like a line item, not a threat. It sits on the sheet looking stable, almost boring. It gets compressed in the same mental drawer as trash pickup or internet. But an HOA fee is not just a passive utility. It is a variable cost tied to shared expenses, board decisions, deferred maintenance, insurance pressure, vendor contracts, landscaping, roofs, elevators, pools, legal fights, staffing, and whatever years of underfunding finally decide to become your problem. That is why the fee can feel harmless before you move in and invasive after you do. You are not just buying square footage. You are buying exposure to collective upkeep and collective decision-making. If the neighborhood or building has expensive problems, the bill does not arrive as a philosophical concept. It arrives as a monthly obligation attached to your address. And unlike a bad restaurant subscription, you do not cancel it and keep the home. The HOA is welded onto the property. This is not a niche issue. Realtor.com reported on January 15, 2025, that 1 in 4 owner households in the United States pays HOA or condo fees. Read that again. 1 in 4. This is not some weird luxury edge case. It is part of mainstream ownership for millions of people. Realtor also reported that the median HOA fee in 2024 was $125 a month, up from $110 in 2019. That number sounds manageable until you remember medians hide the sharp stuff. The same report said nearly 3 million owner households were paying more than $500 a month in HOA or condo fees. More than $500 every month before the mortgage has even finished asking for its share. The exposure is also everywhere in the listings market. Realtor said 40.5% of for-sale homes in 2024 had an HOA fee attached. For newly built homes, the share was even higher at 69.9%. If you buy newer inventory, The odds of buying into a fee structure are not small. They are normal. And if you are shopping condos, the association question becomes even harder to ignore. Realtor reported 83.8% of condo listings had HOA fees in 2024, with a median of $370 a month. That is where the phrase second mortgage starts sounding less dramatic and more literal. Once a fee pushes into the hundreds, it is not decor. It is architecture in your budget. The emotional damage is not just the number, it is the power dynamic. A mortgage feels brutal, but at least the terms are clear. An HOA feels like another authority standing inside the walls of your ownership telling you what this home is now going to cost. The fee can rise because the master insurance got hit, because the roof aged, because reserves were thin, because vendors cost more, because somebody finally stopped pretending the future would be cheap. So the fee does not just hit as an expense. It hits as a reminder that ownership is never only about your private unit. Shared structures create shared bills, and shared bills create shared exposure. Your finances get linked to the competence, honesty, and timing of other people. The StatPsyche is why a calm assessment letter can trigger a very irrational-looking amount of rage. It does not feel like maintenance. It feels like consent being re-edited. Now the budget starts doing that ugly homeowner choreography. If the HOA goes up, the cushion goes down. If the cushion goes down, the next repair hits harder. If a special assessment shows up on top of the higher monthly fee, the whole month bends around it. You start resenting things you used to call amenities. The pool is not a perk anymore. The gate is not luxury. The landscaping is not charming. They become visual explanations for why your checking account never fully relaxes. You also start seeing the social side of the trap. From the outside, you still look like someone who made it. Nice place, good neighborhood, shared amenities, clean common areas. What nobody sees is that your housing cost is now partly controlled by a board packet, a reserve study, and a meeting you wish you never had to attend. And that is the core of the fear. The bill is not only high, the bill is structural. In the morning, you stop treating the HOA as a side cost and start treating it like housing, not optional housing, real housing. You build it into the monthly number that decides whether the place is affordable. You read the budget, the reserve language, the recent increases, and the meeting notes if you can get them. You ask what the dues cover, what they do not cover, and what ugly deferred maintenance might still be waiting backstage. If you are buying, you do that before you romanticize the lobby, the gym, or the clean exterior. If you already own, you start planning around the fee like it is part of the mortgage stack, because emotionally and financially, that is what it is. You thought you bought a home with one monthly payment. Then the HOA reminded you that ownership can come with a second hand on your wallet, and it votes. Welcome to StatPsyche.